Hello and welcome to the Investment Markets podcast, where we aim to discuss investment matters that impact self-directed investors. I'm your host, Darren Connolly, CEO at Investment Markets, and with me today is Daryl Wilson, founder and portfolio manager at Affluence Funds Management. Affluence provide access to a wide variety of investment managers across different asset classes and investment types through their 4 investment vehicles. However, before Daryl and I get into it, I need to remind you that this is general advice and general information only, and nothing in this podcast should be construed as an investment recommendation. You will need to decide what is right for you. Welcome, Daryl.
Thanks, Darren. It's great to be here.
Before we get started, can you give the audience a little bit of a brief background on your career, investing history, and why you founded Affluence?
Yeah, sure. So I grew up in a small town in New Zealand and was inspired by a high school teacher to become an accountant. And that was the first 10 years of my career. Loved it, quite enjoyed it. And then my wife and I made a pivotal decision in the very late 90s to move to Australia. Sort of a spur-of-the-moment decision, landed on Brisbane as the place to go. We had our first child on the way. So it was one of those sliding door moments where we did something, on the spur of the moment generally, and it worked out fine. So as part of that, I ended up at a little company called Cromwell, which was a very small property fund manager.
I have heard of it.
You have? I know you have. Yes, we did work together for a short time. And I was there for 15 years, and it was an amazing place because we grew it from what was effectively a micro-cap ASX listed stock trading at 1 or 2 or 3 cents to well over $1 and an ASX 200 company. So I was along for that ride along with 3 or 4 founders who had recapitalised it the year before I came. And it was just genuinely amazing to be part of a company that grew so much over such a long period. And so there I learned all about funds management, initially property, and then sort of detouring into equities and other things as well. It was a fantastic time, and it was a great team. I had several mentors there that taught me a lot. And a couple of things happened that were kind of pivotal that led to Affluence. Firstly, I met Greg Lander, who is my investment portfolio partner at Affluence, and so we manage all of the portfolios together. We had thousands of investors at Cromwell, and we focused our products, unusually, probably, for the kind of mums and dads, the grandmas and grandpas out there, the direct investors, rather than focusing on perhaps advisors or large institutional clients. And so all of our products were designed around their needs, income, decent returns, surviving market downturns. And so that was important. And then I think eventually, I sort of, one of my jobs at Cromwell was investor relations. And so I would meet fund managers. And because we'd grown so much, I met literally hundreds of fund managers over the years. And the interesting thing was, when we were very small, these fund managers would come in who we'd never heard of, and they were incredibly smart. They'd found us out of nowhere. They knew what they wanted. They asked intelligent questions. And I thought, that's interesting. These smaller fund managers really know their stuff. And as we grew and as the fund managers got larger, we actually got less and less impressed with the quality of the questions they were asking and the work they did. So, I sort of started thinking, well, what if we could put a whole bunch of these fund managers together and take that out as a product? So
it's like the best of the best.
The best of the best. And that became really the gem of an idea for what is now the Affluence Investment Fund, which was our first product. And so we started that in 2014, initially inside Cromwell with Cromwell's blessing. We weren't sure if it was going to be a Cromwell product or not. And in the end, the board decided they wanted to stick to their property background and they didn't want to diversify. And so at that point, I left to form Affluence, launched the Affluence Investment Fund. Greg Lander joined me a few months later, and we've been working together ever since.
So that's nearly 10 years now at this stage.
Yeah.
Is there an anniversary?
Well, depending on when you measure it, because initially the fund started in late 2014, so we've had our 10-year anniversary, but we only opened the fund in 2015. So, yeah, either way, it's just 10 years, I think. And it's been a wonderful, wonderful 10 years.
And what would be maybe one or two of the key highlights across those 10 years that stick in your mind?
I think so we set up, all four of our funds are set up to do three things well. We want to outperform over a reasonable time frame. We want to survive the market bumps better than most.
Yep.
And we want to give people regular income if they want it. So all of our funds deliver those things. And probably the most interesting thing we're most proud of is surviving the tough times, so sailing through COVID, recovering the losses within a few months, all of the major drawdowns we've managed to survive. And that's crucially important for our investors, because if you don't get spooked and don't have to make a decision, if you don't look at your super or look at your investments and see you're down 20 or 30%, it saves a lot of angst. It saves you having to potentially make decisions you'll regret later. So that's probably an important thing that we do that others probably don't do as well.
So how do you set the funds up to manage that black swan event or the tail risk? How do you construct them to make sure those mums and dad investors, obviously very sensitive, don't want to lose any of their hard-earned money that they put into the funds? What have you done that actually is maybe a little bit different from other fund managers to cope with that?
There's a whole range of things that we have kind of at our disposal, but some of the main ones. The first one is diversification, and by that I mean proper diversification. So yes, if you look at our Affluence investment fund, it is diversified by asset class, but it's also got over 30 underlying investment managers there. It's diversified by geography, and importantly by investment style and investment strategy. So different ways of investing. Even though you could have 5 different funds, for example, investing in the Australian equities market, when the equities market goes up, not all of those will keep up. When the market goes down, some will do a lot better than others. And so we try to have a range of different investments that are going to behave in different ways. So that's the main way we diversify. And then we also we can carry extra cash, if we feel like we can't find a lot to buy. We can hedge, which we do not all the time, but quite a bit of the time, depending on how we're feeling about markets and how our investment portfolio looks. And they're probably the main things, but there are also other ways, you can help protect in those downturns as well. But different things work in different times. So when we had the COVID downturn, the hedges worked really well. In the most recent downturn, we had things like gold miners in the portfolio and a bit of extra cash going into it, and just a lot of the managers themselves performed very well. So every downturn's different.
And we've seen queues outside some of the gold bullion dealerships.
We have.
So is that a sign for you? Is that a canary in the gold mine, so to speak?
It's actually topical because it's been a source of a lot of discussion internally. So we are a little bit contrarian. We're definitely a value manager, so we're always looking to invest in things when people don't necessarily want to. And when everyone wants it, we're thinking, well, gee, maybe we should be selling this.
The taxi driver on your way here is telling you to buy gold. It's
exactly a little bit. But being a contrarian is hard. You can't be contrarian all the time because the market actually gets it right, maybe 70 to 80% of the time. So you want to be a contrarian at turning points. And so, for example, one of the discussions we were having, we there's lots of Twitter posts with those people queued around the block. One of the first questions we had is, well, actually, are they buying gold or are they selling gold? What are they doing?
Yeah.
And so, we're starting to get, we're starting to feel like certainly that stuff's a little bit stretched, the gold price in particular. But, we owned gold miners back in 2015. We owned them 2 or 3 years ago when I can tell you no one wanted them.
Yep.
And the interesting thing is that, the exposure we have to gold in the portfolio now is mostly through junior miners. And so what tends to happen as markets rally is the gold price moves first, then the large miners, then the medium miners, then the small, and then the speculative. So the small stuff's really, kicking along now, but that's only started in the last 2 or 3 months. And the true retail buying of the gold ETFs has only started in the last few months. So if you go back and look at the 70s, it could have a lot further to run yet.
Yep.
So, our response to that sort of environment is maybe sell a little bit, take some wins off the table, keep an exposure, watch it closely.
Yep. And when you say contrarian, it may be contrarian by choice or contrarian by design. How do you arrive at those contrarian positions? Because sometimes, as you said, the market gets it right mostly in the long run, certainly. How do you pick those points? Because that's notoriously difficult to get that right.
It is. And so I think the starting point for us is it's got to be demonstrably cheap. So if we look at, and so a lot of our portfolio is focused around discount investing in things where we can value it because it's got an underlying net asset value, or so it could be something like a REIT.
Yep.
We have a fund that invests in LICs, which we can talk about, which, they all have investments that they're valuable every day. So we know what the discount is. And so if we can get a discount, if we can buy $1 worth of assets for 90, 80, 70, 60, 50 cents even sometimes, that's a good starting point. So that's the bedrock of what we do. True contrarianism, if we were going to take a larger bet, you want to see everyone on one side of the coin, right? So
does that ever happen?
Not usually for very long, because when there are no buyers left, what tends to happen is the price then falls. And so we do look at sentiment measures, but I would say that's more along a scale than anything else. So, when everyone hates something, that can be a good time to buy. When everyone loves something, that can be a good time to sell. But your time horizon still has to be 2 or 3 years because you will get it wrong. And as a value investor, I can tell you, we are almost always early.
Yep.
So you've got to be prepared. Everything we do is like, well, okay, over the next 2 or 3 years, you've got to give these things time to play out.
Yep.
And you might be wrong for a year before you're right.
And that could be painful.
It can be painful. And the way we deal with that is our largest investments tend to be in things where if we're wrong, the pain is not very great at all.
Yeah.
So it sounds a bit weird, but if we could make a really comfortable 10 to 12% on an investment over the next 2 or 3 years, and maybe the downside is very small, that might be quite a large position in our portfolio. Whereas there could be other things where we're pretty comfortable we're going to make 50 or 60%, but it might fall 30% first. And that's going to be a much smaller position because you've got to be able to take that pain and maybe even top up along the way. So you can't start with a large position. So that's a large part of our risk management as well.
Yeah. So that diversification approach, which you alluded to earlier, I guess is part of how you protect the mums and dads, the capital that they're putting into the funds.
Absolutely.
Have there been any specific examples where you've maybe turned around and said, there's an opportunity, but that's not for us because the risk is too high, so you've sacrificed maybe some of the potential outperformance because the capital protection piece is more important?
Yeah, I think there's it varies depending on market cycles. And at the moment, there's probably not too much we feel like we're missing out on. But the toughest times actually tend to be when you're in a big drawdown and, there's 100 things or 1,000 things you could buy and you have to make some hard choices around, well, all of these might work out. What's my range of outcomes? So every time we look at an investment, it's like, what are the range of outcomes? So sometimes we can own things that might conceivably go to zero, but it would be like 0.25% position.
Yep.
And if we're right, we might triple or quadruple our money, but you can't take the risk that you burn 3 or 4% on one single investment. So there's heaps of examples, but it's very much specific to the environment. Yeah.
And you alluded to the range of managers that you'll look at that maybe sort of uninvest in. How do you so it obviously brings on manager risk.
Yep.
How do you vet? How do you identify those potential managers? You did allude to some of the best returns are often in the smaller players, but how do you vet those managers and decide this one is right for us and should sit in our fund?
So there's a few steps. When we started Affluence, we spent about 6 months going through the entire, if you think of the Morningstar database, which has got, I think, 10 or 12,000 managed funds in it.
There's quite a few.
Well, we started by screening and said, well, okay, who's been around for sort of 7 years or longer and outperformed the index by a couple of % over those 7 years? that dropped about 90 to 95% of them. So that was easy.
Well, that's a bit of a scary fact just on its own, isn't it?
It is, and that's the industry. So people will tell you, a large amount of managers underperform, after fees and costs, and they do. So you've got to find the ones who can outperform. So we did that. We then broadened our search and went to so the Morningstar database is great, but doesn't include a lot of wholesale and boutique managers. So we used 2 or 3 other databases and a bunch of other sources to identify wholesale managers as well. And that actually brought a lot more into the fold. And then it's sort of a process of, okay, have they outperformed a reasonable benchmark? What's this team doing? They're almost always boutique. And by that, I mean they're almost a small team operating within a sturdy environment who've been investing together for quite some time.
Good stability.
Stability. Yeah. So it's not about the name of the company. It's about who the investment team are and whether that's changed over the years. So one of the things we look very closely at, if there was a team of 2 or 3 and one of those core team members left, we would give a very hard look at that, whether we want to continue having that investment on the same scale, because it's all about the investment team, despite what people will tell you about the process being repeatable.
Yep.
And then we sort of drill down and go, okay, what's the advantage here? How are they making money? How are they able to outperform? Do we understand it? Does it make sense? Is it repeatable? How much money have they got? Where's the top? And I can tell you a lot of the investors we put money with are either what we call hard close, and they're not taking any more money, or they're soft close, which means they're not taking any new clients, but existing clients can still add more because they know that their biggest nemesis as a fund manager is too much money. Yep. And you see this time and time again.
Yeah, they got pressure to deploy.
Exactly. Yep. And then we meet the managers, obviously. We like to meet them personally. What we're trying to understand when we meet a manager is, what sort of person are they? So things like passion, focus, dedication, competitiveness, being risk aware, being happy to talk about your mistakes. That's a key thing we like to see from managers. What environment are they in? Who are their service providers? All those sorts of things make a difference at the end of the day to having a stable, kind of coherent team. So that's the next step, because it's important to us to understand what conditions a fund will thrive in and what conditions a fund will not. And so the last step to actually get into our portfolio is to say, okay, is this differentiated enough to what we already have? Or do we already have 3 small cap growth managers and this is the 4th one, and that's not really going to add a lot to our portfolio in terms of diversification. So is it different? How will it react? And I can tell you, we focus on managers who do their best work when markets are perhaps flat to down, because that's when we want to add value for our clients. So if you invest in any of our funds, they all have different risk reward criteria, but what you should generally expect is when markets are ripping ahead, we won't keep up very well.
Yep.
But when markets are flat to up a bit, and definitely when they're down, we'll outperform those markets. So again, it's just coming back to doing our best work when our investors want us the most.
Yep. And does that become hard at times? Because when markets are on a tear, human nature is that people just look at the performance figures.
Yep.
And then they'll pick number 1 or number 2 on the performance table, when actually you've got a different story to tell.
Yeah. I think it focuses us on, and this is the other key thing as a fund manager, it focuses on what sort of investors we're going to attract and who wants to be with us. So, if you're young and you're expecting to make 40, 50% a year and you're in crypto and a bunch of things, we're just not the manager for you. We're never going to be, the beautiful thing is we're never going to be top of the tables in any given year, but over 10 years, we're always near the top of the table because we sort of outperform average most of the time. And eventually, it's like the little engine that could, eventually you climb the hill further than everybody else and faster than everybody else. So that's kind of where we focus. And so therefore our investors tend to be, let's say, slightly more on the conservative side. They tend to value what we're bringing to the table. And that's important to us because, when markets are ripping ahead, they won't be too worried about that. They've already made their 5 or 10% for the year. They're not too worried about making more. They want us to do our best work when things are a bit shaky, and then they can give us a little bit more money and say, well, let's put that to work. And that, as a fund manager, we love that. We love that when, you go through a rough patch, investors are happy to top up and get the benefit of markets being on sale.
Are there any, just taking that a little bit further, are there any particular risk metrics that then you focus people in on? So instead of going, hey, the market's done X percent, we're maybe a little bit below that, but actually we want you to look at this.
Yeah. I think, we put a couple of charts in all of our reports. We put the long-term chart of how each fund has performed versus whatever the benchmark or the index is we're measured against. And so you can see there that over the long term, we've always outperformed, not necessarily month to month or year to year. But again, if you haven't got a minimum sort of 3 or 4 year time horizon, we're probably not right for you as an investor. And then we put every monthly return in a table so people can see what the best months are, what the worst months, best years, worst years. And that's the thing.
So like a heat map?
Almost like a heat map. We do. We colour it red and green so you can see quite clearly what our best and worst months are, best and worst years. And that helped, now that we've got a 10-year track record in our investment fund and about 8 or 9 years in 2 of our other funds, people have got a long period of history to look at and they can figure out themselves kind of almost intrinsically whether that gels with what their expectations are. Yep. So you can run a whole heap of, ratios, Sortinos and Sharps and all those things, but they don't mean a lot to most people. We do talk about how we're less volatile, which means we have less ups and downs, but most people don't have a reference point for that. So it tends to be a bit meaningless.
But you think, is that a wider issue with the industry? Because the focus just tends to be on the benchmark and over or under, and
I think
very little else is usually talked about.
It is, and I think people, it is a wider issue for the industry. And look, people's natural inclination is to chase performance. Is you want to look at the things that have had the best last year and the best last 2 years. Interestingly enough, for us, we're more likely to top up a manager when they've had a pretty average 1 or 2 years, but a great long-term track record. And there's a brilliant piece of research from a US crowd called Research Affiliates, which they did a few years ago now. They looked at 25 years of data, and they discovered that over a 3-year period, the best cohort of fund managers were the ones that had the worst last 3 years. So it's almost that buying the dip mentality because, to be clear, not every style works well. Not every manager outperforms all the time, and not every style works well, sometimes for years. I mean, as a value manager, I can tell you
there's pain in the cycle.
It's been a tough, most of the last 10 years has been neutral to unfriendly to the value style of investing, and yet we've still gone pretty well. So, but you feel like you're swimming upstream most of the time. So that's a real thing. And so I think, one of the arts for us in looking at a lot of managers and choosing managers when they've outperformed and underperformed is to ask ourselves why. Yep. And is that what we expected? We've had times when we've cut a manager who's outperformed because we couldn't understand why. That, what we knew about that manager shouldn't have meant they've outperformed, and vice versa,
Or have they run too hard for too long?
Have they run too hard? Are they doing something we don't understand because, they shouldn't have gone this well? And sometimes, a lot of the time we talk to them, they explain it and it makes sense. So, but, it's something we look at. We have an expectation of how each investment should go depending on how the market's gone. And we talk to the ones where that expectation is not what happened. And that's the best way, one of the best ways we monitor our portfolio.
So from the perspective of some of those mums and dads, so if they were to invest in another fund, they're effectively got to do the due diligence on the fund manager themselves.
Yep.
They're buying a particular style. Maybe they're buying a relatively tight selection of stocks. Whereas if I'm interpreting this correctly with your funds, actually all of that work is essentially being done, and you're spreading that risk, that manager risk, over 15, 20, 25 carefully researched managers. Is that
absolutely
correct?
Yeah, that is correct. And so certainly you're getting that. You're getting different. And in terms of how that fits into someone's portfolio, I guess the bit we don't really do is the ASX 200, the S&P 500. We don't do those mega cap stocks much in our portfolio because we can't add a lot of value.
Yeah.
And so a lot of people are moving to ETFs for that sort of space. We're giving people to everything else. So through the investment fund is our broadest fund, and through our 3 specialist funds, you get specific strategies. But you're getting everything else. And so a lot of investors pair us with an ETF or a passive or a large cap manager where, we're going to behave differently and hopefully be a bit of a cushion at certain times.
So like a core satellite strategy.
Core satellite, absolutely. So we can be, we can be a core or we can be a satellite. And certainly our specialist funds are more likely to be a satellite allocation for people. Yeah.
Now you touched on ETFs, obviously weight of money flowing into that particular structure. On the flip side, and I know you have a LIC fund, LICs, if I'm maybe a little bit unloved, if maybe that's fair, certainly operating at a discount to net asset value, a lot of them.
Yep.
What's your view on, maybe a view on ETFs first, and whether or not they're distorting the market or there's an issue around ETFs? And then correspondingly, your view on LICs and how that sector is going and the pros and cons of LICs.
Yeah.
I know it's subject close to your heart.
Yeah, absolutely. Look, so with ETFs and passive investing in general, I would say there is no doubt that there is money flowing out of active managers and into passive vehicles, and particularly ETFs. The ETF field is growing. There's some exceptionally good product out there. We're definitely not anti-ETF, anti-passive investing. To get your exposure to the larger companies, that's usually the best place to be. And if we go back to where we started, if you're in one of those 90% of funds that underperforms because they're not really doing anything too different and charging an active fee, you should be in an ETF. So that's what's happening in the funds management world. Money's moving away from the managers who aren't adding any value and towards passive, and a little bit towards, like us, active managers who can make a difference over time. The LIC market, we started our LIC fund. And so just for the audience, if you don't know, LICs are listed investment companies. They're essentially listed funds, mostly in a corporate structure, but they don't trade at NAV like an ETF does. So they trade at a discount or a premium, so they can trade above or below. And we started first investing in that sector back in 2015. We set up a dedicated fund to do that in 2016, and we've been investing in the sector ever since. Now, at the moment, there's kind of 2 halves to that whole space. The first part is the debt-focused listed investment companies and trusts. They're wildly popular. They're trading at par. They're paying monthly income. They're doing quite a good job. But some of them are trading at, in fact, above their asset value. So there's not a lot of value we can add at the moment in that space. Following a market correction, absolutely, we'll be very heavily into that space.
Keeping an eye on it.
Yeah, exactly. Yeah. Everything else at the moment, which involves LICs that invest in equities, private equity, alternative strategies, no one wants them. So probably the worst point was May, June this year, when tax loss season happened. A portfolio, we measure the average discount across our portfolio. We have done every month since we started. That was 26, 27% in June this year.
That's quite a lot.
That's a lot. So you're really buying $1 worth of assets for 72, 73 cents, 74 cents.
Yep. But is that not value?
It's extreme value because it's the largest discount we've ever seen since we started. And bear in mind, that includes the COVID correction and every other correction in the middle. So
even more of a discount than COVID.
Even more of a discount. And in fact, it was a bit of a double whammy because a lot of the LICs we own at the moment are in, for example, the small cap space, which has also underperformed the market. There's a heap more value in small caps, in resources, in some of the private equity LICs than in the large cap space.
Yep.
So you get this, and we love this stuff. You get this double value. You're getting value because you're getting a discount. You're getting value because the portfolios are just cheap. Now, since then, in the last 3 months, we're probably up about 12% in our LIC fund. And all of that has come from those portfolios re-rating and us sort of moving the portfolio around. The discount is still 25, 26%. So there's still extreme value there in the discount. The value of the portfolios has come up a little bit, but really This is a sort of environment we've seen 2 or 3 times in the last 9 years, and coming out of this environment, we tend to do quite well.
So what's driving the discounts? Because they've been there so it might be a peak discount, but the discount has been there for quite a while.
Yeah, it has.
What's made it so large? And then what do you think might drive a turning point to compress the discount a little bit?
There's a few things that made it quite large. It all started about 4 years ago when the Labor government decided they might tinker with the eligibility for franking credits, and that started to make these things less attractive. That went away. Then COVID happened, and that drove discounts. Then they recovered. And then in 2022, when interest rates started rising, what happened was that made other sectors more attractive than LICs, particularly private credit and listed vehicles that invested in private credit. And so
everybody's in private credit.
Everybody's in private credit. Yeah. It's been in the news a lot. Obviously it's quite topical, but certainly that impacted people's love for LICs. And so they're very, very friendless up until recently. We've just started to see in the last, as I've mentioned, the 2 or 3 months that's starting to turn around. So the sellers have gone, the buyers are starting to come back. And we think we're at this sort of tipping point now where we see interest rate falls from here. Again, that will help to drive that narrative. More people will start to look at the income that's available from LICs and sort of start to find them more attractive. Things like private credit, maybe a little bit less so, because most of those are variable. So as interest rates fall, the yields on those will fall as well. Yeah. Yep. So that we're at this sort of, I think, this important point in the cycle. But you know what? When you're buying a portfolio of LICs at a 25% discount, you actually don't, this may sound strange, we don't need that discount to close to make good money, because, you've got $1 put to work by a really good manager who's running that LIC, and you've only paid 75 cents for it. So if they deliver 8% on that $1, that's like a 10 or 11% return for you, because you've only paid 75 cents. And so you get this magnifying effect of you're having bought it cheaply.
Yeah. Which I don't think most people see, because they just look at the price.
Correct. And they look at the returns that the manager has generated, but they don't necessarily think about the returns they've generated. And so, and a lot of the best opportunities are also not necessarily in the high dividend payers. In fact, it's almost the opposite. So, one of the big mistakes we see people make in the LIC space is just buying yield. And quite often yield is expensive. So yield means something's trading at a premium and it's popular, and then that can turn around. We've seen situations where individual LICs go from a 10 or 20% premium to a discount. And even though the underlying managers made money, the investors lost money.
That's painful.
And they sort of scratch their heads and go, what happened?
Yeah.
So that's why we focus on both those things. We focus on how well are we buying this? Are we buying it well? Are we buying it at a discount? What should that discount be? And what's this portfolio? Are we happy to own it? Do we like it? Is it got, what are the prospects?
Yep. So. Are we likely to see more corporate activity in the LIC space? Because we've seen a little bit of that where some investors have agitated for some wind-ups.
Yep.
Is that going to continue? Do you think we're going to see more of that?
We think so. We've probably seen 20 or 25 LICs in the last, say, 3 years wind up, delist, merge. We'll see some more, but I think the bulk of that is now done. And so, as sentiment slowly improves, you might actually start to see some new ones coming to market. That's a way off yet. But
so has that taken out some of the larger discounts, weaker players?
It's taken out some of the poorer performers, actually, which is what it should do. So not necessarily. Most of those were probably small to medium-sized LICs being gobbled up by a larger one or delisted into a fund, but a lot of them hadn't performed. And so while the standard of LIC managers is actually very, very high compared to, say, unlisted funds, we have weeded out a few that probably shouldn't be there. There's still some left. There's still, the universe for us is about 85 LICs in total. We will generally screen out about 25 of those as not investable for various reasons. Maybe they're just too small. Maybe they're not interesting enough. Maybe we don't have a high opinion of management.
Yep.
And then we supplement that with things like REITs and other discount opportunities that we can do in that LIC fund. So our total investable universe is probably 120 or 130 stocks.
Okay, that's quite a lot.
It's still quite a lot, yeah. And we're aiming to put a portfolio together of sort of 25 to 35
of the best.
And that varies. You can tell probably how much we like the sector at any given time by how many's in our portfolio. So at the moment, we're right at the top end of that range because there's a lot of opportunities to buy things. And, we're not geniuses. So we can look at an LIC and we can say, well, okay, that discount's too high. We like that portfolio. That should change. But we can't tell you when. So again, it comes back to saying, well, over 3 years, we're almost certainly going to be on to a winner there.
But you may be
But it might take 3 months or it might take 2.5 years. Absolutely. So the way we deal with that is when we see a lot of opportunities, we own a lot of things.
Yep.
And when we see less, we own less.
Yep. Now, you touched on yield. So for many mums and dads, investors, yield is really important. They look for income. It was something that I know that Cromwell was very focused on as well at the time. How do you deliver for income for those investors? And what particularly are you investing in? Do you look at private credit, for example, or are you investing in sort of the more traditional fixed income product range?
Yep. So all of our funds have an income component. We tend to set the bar at 5% per annum. So that's the minimum that we would like to distribute. That's, in our view, that's a fair return. And over the medium term, if we can't do 5% per annum or better, we shouldn't be here. We should give the money back and go home. All of our funds distribute monthly or quarterly, depending on. So our investment fund and our income-focused fund distribute monthly, our LIC fund and our small company fund quarterly. And essentially that 5% comes from various sources. The bedrock of that does tend to be fixed income, the dividends or the distributions that we collect from the equity invested funds, and a few other things we'll do from time to time. We do a little bit of what we call special situation investing, where there's sort of specific situations, event driven, or could be a capital raise or a delisting or something we take advantage of that might have some income.
Can you give us an example of that?
At the moment, we've got for example, one of the investments in a couple of our portfolios is URF, which is a US residential fund. It owns a bunch of units in New York and New Jersey, and it's winding down, basically. It's now 40 to 50% owned by a bunch of hedge fund managers who've come on the register in the last few years, and they're driving management to sell down these units. And so it's trading at about 20 to 30% below the value of its assets. We know that over the next 2 to 3 years,
they're going to try and realize that.
Going to come back.
Yep.
And so that's not technically, the actual portfolio is not delivering really any income. But over the next 2 to 3 years, we know we're probably going to make, let's call it 15 to 30% off the back of that money slowly coming back.
Yep. As they crystallize
the portfolio. They're selling every single month. They announce we've sold this many, we've used this much to pay back the loans. Here's how much more cash we've got, and periodically they'll distribute that out. So we know we're going to make probably good money. We don't exactly know how long it will take, and that will make a difference to our final return, but we're pretty comfortable we're going to get a return and a positive return. So that's not technically income in the traditional sense of the word, but it's crystallizing a capital gain that then becomes distributable as a fund manager. So there's a few quirky things we do like that. And what we've tended to find is that, at the end of each financial year, we'll look at each fund, and if we've done better than 5%, which we tend to do most years, then, we can make a special or a slightly higher distribution at the end of June. But, it's like, look, you can have 5%. It might be more or not. If you want to reinvest, you can. If you don't want the income, that's fine. It's just giving people that choice, really.
Now, in a lot of the news, business news, investment news, people are talking about private credit. Most private credit funds will be, their headline rates will be substantially higher than 5%. Yep. Some of them double digits. I've seen 14, 15, 16%. What's your view on where that market's going? Because it seems to be absorbing a lot of investor capital. And I've never seen the credit cycle disappear. It just usually goes somewhere and it bites somebody in the ass at some point. Yeah. What's your position on private credit?
Yep. So it's quite nuanced, but I would say a couple of things. So we have an income fund. We set that up about 2 and a bit years ago, and we really, up until then, the return, with interest rates close to zero, the returns from fixed income were quite frankly rubbish.
Yep.
We had almost no fixed income in the portfolio in any of our funds. It was too hard. Then we started looking around when interest rates started going up. We did a deep dive on the entire fixed income sector, which is obviously things like bonds, listed traded credit, and the private credit stuff. And I would say there's a definite advantage in the private credit space. So over the long term, there's a genuine opportunity here. There's a genuine advantage they have over others, which is they're going to be able to earn 2 or 3% above the average rate for a larger publicly traded bond, for example. Now, there's some reasons you get that, and a couple of those reasons are they're certainly less liquid than bonds, they're less transparent than bonds, and they're less sort of mark to market. So, you are losing some sight of what you have underneath that.
Yeah, the reward and the risk part never gets completely...
No. And so you've got to understand why you're getting that. But like for like, we really like the private credit space at the moment. Within our income fund, again, that's a fund-to-fund type structure, and we can go anywhere, do anything. And about probably 65% of the portfolio currently is allocated to a whole lot of private credit managers in different subsectors doing different things. So the manager quality is exceptional.
And what makes you pick a particular manager in that space? So we did talk about that a little bit at the start, but for private credit in particular, what's the additional considerations you're looking at?
A lot of the key metrics are the same. So what are they doing? Is it different for us? Is it going to add value from a diversification point of view? Are we getting paid commensurate for our risk? Then there's a couple of extra layers. As you point out, in credit and in fixed income generally, your upside is known. Your maximum return is almost guaranteed. You can't go much above that. And then it depends whatever the manager's doing, but it might be 6, 7, 8, 9, 10%. Your downside is not known. And so most of our effort when we're due diligencing a fixed income manager, whether it's private credit or bonds or anything, is around risk management. What's the downside? For example, in 2022, a lot of the investment world discovered that so-called duration was a problem. So long-term bonds at fixed rates actually fell in value because when interest rates go up, that's what they do. And so this supposed bond fund that was supposed to do very well in a downturn actually went down at the same time as equity markets. And that's terrible for people who'd done the sort of 60-40. So we have, if you go to our website, there's a presentation on the fund. There's a single slide in there that talks about the key things we look for, and it's things like diversification. It's things like, are the economics being shared equally? So in a lot of cases, the manager will ultimately be charging 3 or 4% and the investor's getting 6 or 7. That's not fair. If there's 10% to go around, it should be maybe 8.5, 1.5, or something close to that. There's
sometimes a lot of cream on the top that investors aren't aware of.
There is. So ASIC published a report on the sector recently. They certainly hit on 4 or 5 key things investors should be looking out for. We would agree with all of those, and we would probably add a few more. And particularly for retail investors, while there's a lot of great managers in the sector, some of the product is questionable. And our biggest concern tends to be that those economics are not being shared equally, where there's a high fee and the returns don't match the risk you're taking.
And if people remember back long enough and the situation with mortgage funds, there's always the possibility that similar things can happen.
Absolutely. And look, I've been on the other side of the ledger at Cromwell. I was the CFO for many years. I was the borrower. We've looked at all these structures. We've been on the other side. We know how these work. We actually ran mortgage funds in the early 2000s as well. We've been through the GFC, so we know how things can turn. And so, it's interesting. One of the biggest areas we focus on when we're putting together our income portfolio is actually liquidity. Yep. And it's not necessarily direct liquidity, because the problem is a lot of managers will promise liquidity that isn't necessarily there in a downturn. But it's actually, what do the underlying loans look like? How diversified are they? How long are they? How often are they going to turn over? So, because in a downturn, if people want their money back, that's what will matter. It's actually, are some of these loans going to get paid back so the investors can get paid back who want out? So that's a key focus as well.
Yep. Cycles change, but they're always there.
The mistakes tend to be repeated every 10 to 15 years. Yeah, absolutely. They might look slightly different, but fundamentally they're the same mistakes.
Yeah. So if we just think about sort of this year and looking back, and maybe from a sort of broader macro perspective, how do you think the year's progressed? Which asset classes maybe have been underappreciated or maybe over benefited from additional capital? And how are you positioning yourself? So probably a two-part question, looking back.
Yep.
And then how are you positioning your funds for next year? We're going towards the end of the year, probably a different perspective 12 months on from the start of this year.
Yeah, I think so. Well, I think the first thing we would say is the US market is overvalued. And so we have very little exposure to large cap US. And the main reason for that is around the AI build out. So we're old property people. We know what's happening here. What's happening here is these companies that used to be capital light are now spending billions and billions of dollars on very capital intensive assets that they will be depreciating a lot faster than they think.
With very little revenue on the back of it.
They actually don't even know, I think, what the revenue is going to be in a lot of cases. And we will undoubtedly have a massive overbuild. Now, that might take 2 or 3 years to become obvious. That's probably our best guess is going to take at least another 12 months to become obvious. But when it does, that could lead to a re-rating of some of these large tech giants and a few other areas. And that will unfortunately drive indices down because that's where a lot of the power has come. That's where a lot of the return has come over the last 4 or 5 years. So that's an underweight for us. It's something we're watching closely for the wider market. Other underweights, look, we've been underweight global stocks generally. We tend to want a premium when we go offshore. So to have a large allocation to offshore, we'd want to see the offshore markets being cheaper than Australian markets. And that maybe is the case in some areas, but isn't enough to compensate us for the extra kind of currency risk we're taking. The fact we're not getting franking credits on our equity income to pass through to our investors. In a lot of cases, no, it isn't. So we're underweight that. We're overweight areas like small caps I've mentioned previously. Selected REITs, we're overweight the LIC market in general because of the discounts available. We're a little bit overweight Aussie equities versus offshore equities. We still like the resources space. And selectively. So, and this happens, in the REIT markets, which we invested in quite successfully over the years. If you think of a cycle where you see a correction of some sort and then a recovery, so a quick correction and then a recovery over, well, it feels like 14 minutes most times these days, but it does take a year or two to get back and make new highs sometimes. What tends to happen when those events occur is the first things that start to recover are the largest REITs. And so we'll own those first and they'll recover quite quickly as the discounts close and they move towards their intrinsic value. And then we'll move to the smaller ones and then they'll re-rate and then the tiny ones last, right? So that happens in the REIT market. And it's happening in the resources market over the last 12 months, and will happen over the next 12 or 18 months. So where we're positioned currently, if you look at resources, for example, and this includes gold miners, but it also includes resources generally, we've got 5 or 6 managers in our portfolios that are resource specialists. And I don't know why anyone would want to invest in resources directly because it's so hard to know, there's so much to learn. So much can go wrong. So we very much trust our managers in that space. And we're managing our exposure. So, something like the Baker Steel Gold Fund, for example, which is large to medium miners, gold miners, we have downweighted that over the last 6 months or so because they've re-rated quite heavily. But the small to micro caps, I've only recently started to move. There's a lot more in those. The developers, not quite producers, there's a lot of value still in those. So, and if you think about it, so gold's gone from $2,000 to $4,000 an ounce. I can tell you now, the it's often said the best cure for high prices is high prices. So every single gold manager, mine owner in the world is currently trying to work out how they can pump more gold out of that thing.
Yep.
Everyone who's got their foot on a mine that can be developed is trying to work out how they can develop it.
Yep.
And every large gold miner is trying to work out how they can get their hands on more mines. And so that naturally lends itself.
Pump more out?
Absolutely. So you pump more out. So that, we've got a bit of exposure through our managers to mining services, for example, because that's going to be exceptionally good for mining services over the next 12, 18 months. The larger resources miners will buy the medium and smaller ones to get more product through. And so that will lend itself to a lot of M&A activity in that sort of space. So that's really the focus for us in terms of how we might play that sector. And then if we're right, as we get the wins, we'll slowly take profits and probably eventually downweight as well. So,
and is there a similar theme playing out in the real estate property sector? It's had some tough times, particularly office, over the last couple of years. So you've seen a similar thing play out there?
Yeah, absolutely. It's played out. So at the moment, we're probably 2 years into our investment cycle in REITs. And so we are below our allocation we would have had a year or so ago when there were more opportunities. So one of our bigger holdings at the moment is a REIT called GDI. Their portfolio is almost entirely made up of Perth office buildings. So WA, no one really likes. Office buildings, no one really likes. We love it because it's currently trading on about a 40% discount to its valuations. We know those valuations are pretty good in this. We've been through that part of the cycle and we're now seeing a lot more transactions. So the valuations are good. And bearing in mind, my colleague Greg's a property valuer by trade, so he knows a bit about this stuff. It's trading on an earnings yield of about 9 and a bit %. It's got very little lease expiry over the next couple of years. In fact, there's some vacancy they could let up. The Perth office market is probably the best in Australia, despite what most people think. It's a weird cycle. Normally, Sydney and Melbourne recover first. In this cycle, it's actually Perth and Brisbane that are the strongest markets. And so for the next 18 months, 2 years, we'll probably own that stock, and I think we'll do okay out of it. So that's an example of something where we're fairly late in that recovery cycle, but there's still opportunities.
Yep, and Perth is exposed to the minerals and resources market as well.
Absolutely, and so we think that will you are going to see, and there's a lot of crazy sort of situations where we're seeing new buildings being developed in Perth. Most of the suppliers
or too much anywhere else in capital cities around Australia.
Yeah, and that's good. That's good. We haven't had that massive overbuilding. We're probably not going to see that, and part of the reason for that is, there's competition for construction at the moment. Infrastructure boom is happening. Mining is going to start to suck up a lot more of that capacity. Government, state and federal are spending a lot of money. Here in Brisbane, we're having an Olympics in hopefully 7 years, and we've got to get started building things for that. So if you're trying to build an office building in Brisbane at the moment, good luck. And in a way that underpins the value, because the replacement cost, and this is the case across the board, the replacement cost of any commercial property has gone up by probably 40 to 50% in the last 5 years. So
rents are eventually going to have to follow that as well.
Rents eventually have to follow that, and over the long term, that provides some form of cushion. And construction costs, they might flatline from here or go up slightly, but they don't tend to come down. So, eventually what has to happen is rents have to grow into building values or replacement values, if you think of it that way. Yeah,
it's just going to take a bit of time for that to unfold.
It takes a bit of time. And so, we look at a few situations and we say, well, look, if we're getting maybe a 7 or 8% yield from a REIT, for example, in reality, we're getting paid pretty well to wait. And if we think the capital value's got something upside, and maybe even if that's only going to add 2 or 3% a year, well, suddenly you're looking at double-digit returns pretty comfortably. Not as many things can go wrong. Yeah. So they tend to be the things we like. We're not necessarily in the speculative stuff because, or if we are, it's a small position grounded in 2 or 3 years of patience.
Yep. But you don't need to be.
We don't need to be. We'd much rather clip the ticket on something like that and be patient for 2 or 3 years. I can tell you it's a much easier way to grow your capital over time.
And you get to sleep a bit
easier
at night.
Exactly, where you're up at 2 a.m. checking the US market to see what happened with, whatever tonight. So the one thing about the Trump administration, and we said this when they came to power the second time round, was literally anything can happen. Stuff that you would previously discount as being totally off the table is not impossible anymore. The US restructuring its debt is one example where you would say, well, that, people talked about that in the past. It was never really likely to happen. Maybe it will happen at some point in the next few years. I'm not saying it will, but, the chances of it happening are certainly not zero anymore. So
maybe all those tariffs will pay it off.
Maybe they will. And, the interesting thing about this is, the Trump administration is trying a bunch of things that either have never been tried or have people have said they won't work. And the interesting thing for us is not a lot of them have been absolute failures. So it's really, as an academic exercise, watching the Trump administration go about their work, it's maybe dispelling a couple of myths. It's teaching us things that we didn't know for sure. So it's an interesting time. Whilst we don't spend a lot of time on the macro and the geopolitical stuff, we just run around and look for cheap stuff and buy it. You know, but you have to be aware of what's going on out there, and it's a really interesting time to be an investor.
Yep. I don't think fair to say we've probably got another 3 years of being surprised by what may happen.
Yeah, I think so. And I think that they will probably take their foot off the accelerator a little bit next year because they've got to get through midterms and preserve as much of the majority as they can. But again, once we get through that, so maybe from late next year for the next couple of years, it's all on again. So it will be interesting.
It certainly will. It has been, and I think will continue to be. Now, but just to wrap up, Daryl, over the last 25, 30 years, obviously a lot of experience in investing in various different markets. Have you got a couple of key sort of learnings or pieces of wisdom that you can impart to the audience that have stuck with you that you really abide by?
Yeah, I think if I think back to what has, what have been the cause of the biggest successes and failures that we've seen out there, probably two or three things come to mind. The first one I've already talked about, which is that, the one big advantage you've got as an investor these days is patience. So if we look at everything on a minimum 3-year horizon, that gives us a massive advantage over most of our competitors who are looking at things on a 3-minute to 3-day horizon to 3-month horizon, right? And if you can afford to be patient, there is upside to be had through being patient. The second thing is gearing. Everything you do, more money's been lost on being overgeared in whatever form, whether that's margin loans, direct debt, derivative type plays. I mean, we saw late last week, allegedly, something like a $19 billion US washout in the crypto market. Yep. Bitcoin fell 8 or 9%, not even that, I don't think. And yet all these people were wiped out because they were over leveraged and perhaps didn't understand that. So that's destroyed more capital than anything before. So be aware of where in your portfolio you have leverage and how it's working and where you're exposed. And the third thing I would say that's probably more current is there's never been a better time to be an investor in the smaller end of the market, right? And so whether that's some of the LICs or small caps or micro caps at the moment, no one's investing there, right? So previously, a lot of the large institutional money was in that space. It's all gone. Yep. And so, and there's reasons for that and very valid reasons, and it's probably going to continue to be the case. And so we've got this massive valuation gap between large cap and small cap stocks. And so if you can be in that space, either directly with a manager who's very good at it and you're patient, 3 to 5 year term, you got to make, I think, some very good money in that space. But it'll be an enduring advantage. I don't think we'll ever again see a situation where the small cap market is overvalued to the same degree as it has been in the past because there are just not enough institutional players to get there. So there's always going to be opportunities in that space.
So with that kind of passive flow of money into ETFs and passive investing, it's actually on the flip side creating some opportunities.
Absolutely. I mean, I can't tell you the number of small cap fund managers who have shut their doors over the last 3 or 4 or 5 years because they've lost one major mandate from a super fund or a large institutional client and their business is no longer viable. And all of that money has gone into large cap and in a lot of cases, passive strategies.
Yep.
So if you think about, everyone talks about CBA has gone up and large cap stocks generally have gone up. That's the main reason why. Money's been sucked out of the small end and gone into that large end, and the valuation gap is huge. Now, if you're coming into the markets today, I know which end we want to be in, and we probably will be there for some time in that small and micro cap space.
So it's not an investment recommendation, but it wouldn't be CBA.
It's not an investment recommendation, but just have a look at, there's some very good managers in that space. There's some good opportunities if you're prepared to be patient. So I would say if you're looking for an enduring kind of place to look for a few years, I would say, that's a good place to start looking.
Yeah. So be patient and be prudent.
Absolutely be patient. You have to be patient. Particularly if you're going to look at something like that. You just can't be thinking I'm going to make money over a few months or a couple of years. You've got to be able to run the course.
Yep. Well, that's great insights, Daryl. Thank you very much for your time today, and I'm pretty sure our audience will appreciate your commentary and sort of wisdom. So thanks very much for coming in.
No worries. Pleasure being here. Thanks very much, Darren.
Thank you. Thank you, everybody, for listening. For more insights like this and to search, find, and compare hundreds of investment products, including Affluences, please check out investmentmarkets.com.au.